Hello and welcome to our year-ender series, Outlook 2025. We're going to ask a bunch of economists how the year ahead is going to pan out. It's going to be a tough task for all of them, with President Trump taking on, starting his innings on Jan 20th with the promises of a lot of high tariff barriers. But we have three economists lined up for us. First, Sajjid Chinoy of JPMorgan will be joining us, and thereafter we're going to be joined by two economists from the rating agencies, Dr. Devendra Pant from India Ratings and Aditi Nayar of ICRA. But first, Sajjid is here with us. He's also, of course, a member of the Prime Minister's Economic Advisory Council. Sajjid, thank you very much for your time. First, draw up the global backdrop for us. I know it's tough, but the Fed has just told us that the number of rate cuts are not likely to be 4, but 2. Tell us, will global be a headwind or a tailwind for us?
I think we should be prepared for quite a treacherous global environment in 2025 because there are two distinct and potentially reinforcing shocks in play. And I think it's important to disentangle both of them. The first one, which occurred with the Fed this week, really should not be a surprise for those of us who've been watching the US economy quite closely. The premise that the Fed would cut meaningfully in 2025 was based on the fact that the US economy would slow and inflation would head towards its 2% target. But what we've been seeing all year long is this remarkable US resilience. Despite monetary policy being tighter by historical standards, the US economy, even in the fourth quarter, is still growing at 3%. So forget recession, we're at 3% growth in the fourth quarter. And this has been a story all year long, propelled by a very resilient US consumer. Now, what that's meant is that the last mile of disinflation is getting much more difficult for the Fed. The fact is, if you look at the last 3 or 4 months and you look at the momentum of core inflation in the US, it's actually running at an annualized rate of 3.5%. So we're very far away from 2%. So it was no surprise that having engineered the first 100 basis points of rate cuts, I think the first 100 basis points was non-controversial given how elevated starting points were. For US policy to go from 5.5 to 4.5, was not controversial. Now, beyond that, the Fed will have to move much more cautiously for 2 reasons. One is, as the Fed chairman said, there's so much uncertainty, and we've talked about the Trump administration, that when you're driving on a foggy evening, you want to go slowly. But secondly, given what's happened in the US economy, there's uncertainty now about the neutral rate. There used to be a belief that the US neutral rate was at 2.5%. The Fed has slowly been marking that up towards 3%. I won't be surprised if that neutral rate is much higher than that. So for both these reasons, the Fed has the space to ease much less in 2025. Now, related to this is the Trump tariffs, because if you do get Trump tariffs, what the risk is that you will reinforce some of these dynamics. 2 big parts of the economic agenda for the new president is A, tariffs, and B, slowing the pace of immigration or resulting in deportation. And the dirty little secret is that high levels of immigration have allowed the US to grow at these levels and kept some lead on inflation. If you were to simultaneously slow the pace of immigration and put on tariffs, that is an adverse supply shock, which will push up inflationary pressures even more and will hurt growth. Of course, the US is hoping, equity markets are excited for the most part, because they believe, at least in the US, these 2 adverse supply shocks will be offset by deregulation and easier fiscal policy. The bottom line is there is uncertainty which could push up inflation further next year. We saw that in some of the forecasts of the FOMC members, and therefore the Fed has to move closely. What all of this means, and I'll end with this, is that the US exceptionalism that we've seen in 2024, higher growth, stickier inflation, therefore higher rates, that could get reinforced in 2025 by some of President Trump's policies. And that's why the dollar today is at a 2-year high. And that's why bond yields have backed up again.
Okay. Well, let me straight away come to India and, time permitting, go back to some of the global issues. See, we had almost started penciling in a rate cut from the Reserve Bank in February. But now with the dollar getting so strong, likelihood of say the rupee at 85.50 or 85.30, imported inflation, and the fact that the Fed may not cut very soon in the first half of 2025, does the hope of a rate cut from the Reserve Bank fade?
So I think having tight global financial conditions affects all emerging markets, some more than less. I would argue India is impacted relatively less because we still have very high external buffers. And I keep going back to the point that the India-US policy rate differential back in 2018 used to be 500 basis points. Indian policy rates were 5 percentage points above the US. That narrowed at its bottom all the way to 1 percentage point. And that's another way of saying India did not have to hike in lockstep with the Fed. We had bought ourselves some independent monetary policy because of the quantum of reserves. So just because the Fed is cutting less doesn't preclude the RBI from cutting. I think what will matter more from India's perspective is what's happening with inflation. We're still expecting December CPI to be sticky at 5.5%. So two things will matter going forward from the first quarter. Are we going to see food inflation roll off? That's the hope, given that we've had a strong Kharif harvest, and Rabi should be strong as well. Hopefully food inflation rolls off. And the second is the point that you made, that I think it's important, if the dollar is stronger and all exchange rates are depreciating, that India's exchange rate does not become uncompetitive. I hope at some point we talk about India, China. So if the exchange rate has to become the shock absorber, which it must in some circumstances, there'll be some imported inflation. The good news is we're starting off core inflation at a low level at about 3.5%, 3.6% has been the average over the last year. So hopefully we can absorb some currency depreciation and imported inflation and still have inflation in the 4 handle in the coming months. So there are a lot of ifs in that statement, but if you do in a situation where inflation is in the 4 handle, I think monetary policy will have some space to move in 2025, given the quantum of external buffers India still has. So you use the FX intervention on the dollar front, and you use interest rates to handle domestic conditions, and therefore you've got two instruments for two objectives.
No, I take your point that the Reserve Bank has always maintained that it's not going to use the interest rate instrument for external reasons or triggers. But nevertheless, you haven't answered my question on what's the space available to Reserve Bank. As you see inflation, the nowcast numbers are still looking strong. As you said, 5.5 for December. So is February even live?
I think February is live because the central bank will have to be forward-looking. And the expectation is that Jan, February, March, given how food prices are expected to evolve later in December and January, should be below 5%. So by the February meeting, the RBI will have a much better sense of how food inflation is evolving and what the quantum of this imported inflation is. The RBI's own estimates are about 5% of rupee depreciation adds about 35 basis points to headline CPI over multiple quarters. So I think in February, the central bank believes that inflation is going to be in the 4 handle. I think February is still live, barring more shocks, because I do think we have to also be mindful that we have seen a cyclical slowing in growth, and it's uncertain to the extent to which the economy recovers. So with fiscal policy tightening, monetary policy, given where real rates are, may have to step in and offer some support next year.
Okay. Well, that brings me straight away to the growth question as well. We've got the scare of the second quarter, 5.4, which of course the CEA says could be revised higher. Be that as it may, what's your forecast for the current year itself, current fiscal, I mean, and next year? Are you seeing some meaningful slowdown for both domestic and global reasons?
So we're working with a number of about 6.4 or thereabouts for this fiscal year, which entails a meaningful payback in the second half. But I think it's important to distinguish how much of that payback is because of a very strong agricultural harvest and strong government spending, and therefore controlling for that, what is the underlying business cycle doing? How is core GVA evolving? I think that will be a better signal on where the private sector is and therefore what the outlook for next year is, under the assumption that we have a trade war next year and the US will, we take the president at its word, you put on 60% tariffs or close to that on China. Our China economists have next year's growth below 4%, right? Between 3.5% and 4%, despite the fact that China will do more fiscal, more monetary, and will depreciate the exchange rate meaningfully. Now, the reason this matters for India is what are the channels by which India gets impacted by a trade war? The first channel, which is exports to China, are much less in the case of India compared to a Vietnam or a Singapore or Taiwan. So we don't have to worry about the export angle. We have to be far more vigilant on the imports angle, because what we've seen in the last 3-4 years is a lot of Chinese excess capacity has found itself into many Asian economies, Indonesia, Thailand, India. Now, if the US were to put on tariffs, even more of this excess capacity can be expected to be directed to Asia. And at a time where India would like to see a corporate investment cycle, if you have even more Chinese imports coming in and it's hard to compete with them given the excess capacity they have, then corporates need even more demand visibility going forward to make large investments, especially if the global environment is uncertain. We should be prepared that it's a world in 25 where you could see more global uncertainty, you could see much lower Chinese growth, you could see more imports from China.
Thank you very much for that, Sajjid. Wish you a brilliant 2025. We have to go into a break. Thereafter, we are going to be joined by Aditi Nayar of ICRA and Dr. Devendra Pant of India Ratings. Welcome back to our Outlook 2025 series. The Reserve Bank has just cut its GDP forecast for the fourth quarter to 6.5% from 7.2% that came in the December bulletin. But how are economists taking this revision and how do they see calendar 2025 and FY26? Joining me are two economists, Devendra Kumar Pant, the Chief Economist at India Ratings and Research, and Aditi Nayar, the Chief Economist at ICRA. Aditi, Mr. Pant, thank you very much indeed for joining us. Well, Dr. Pant, let me start with you. I read up your report and you are expecting the Indian economy to grow at just 6.6% in FY26 as well. Would there not be some cheer from the fact that we have a good harvest and there is going to be some, at least, liquidity loosening by the Reserve Bank? Won't all this mean better times for FY26?
Well, Latha, I hope I am in the same camp as you are. As of now, how the situation is, look, liquidity impacts people at the top end of the spectrum. Now, what we are concerned with, earlier we were concerned with the rural demand. Now we are concerned with the urban demand. Until unless inflation comes down and stays at around, say, 4.5%. More than the liquidity, which will have an impact, the overall inflation decline will have a larger impact on the consumption, and so to say on the overall demand in the economy. We don't know how the monsoon is going to pan out in 2025. As of now, like Aditi or any other forecaster, everybody assumes with the normal rainfall, and it's only around June or so we have more idea about how the rainfall is taking place. We don't know how the weather pattern is going to evolve during this February and March. Will it be heat, more hotter condition compared to normal? Will there be excess rain? Will there be hailstorm? So that we are so hopeful about the good Rabi forecast after the output. If that doesn't happen, then even 6.6 will be a problem. Moreover, how from 20th January 2025 the entire landscape is going to change. Will there be a tariff war? There will be tariff increase. Now, how the commodities are going to behave? Whether how the capital flight will inflows or where there will be positive inflows or whether there will be capital flight. So there are so many unknowns. So based on that, we have looked at 6.6, but any of these 3-4 things which I mentioned, if that materializes, then I'm afraid there could be a downward revision. But what government can do, that is a big challenge. And when we talk about government, we generally focus or fixated about the union government. We have to go and look at what each state governments are doing.
Fair enough.
Because if we talk about government capex, union government capex, 11,1100 crore, a large part of is defense capex. That does not create much demand in the economy. So we have to see those things, how they are going to pan out in next year. And based on that, there may be a revision. Which way? As of now, we can't say.
Yeah. I read your report. You did say that gross fixed, government expenditure as well as private expenditure is likely to remain muted in FY26 as well. But Aditi, Dr. Pant has clearly raised the issue of consumption, of inflation bringing down consumption. That naturally focuses on what you expect from the Reserve Bank in calendar 2025. After reading the bulletin, did you get a feel that a February cut is on the cards? What is the cutting cycle at all? Is it 25, 50, 75?
Latha, if I may just add a couple of points to what Dr. Pant just said. I think one of the reasons why we're a little more hopeful of rural sentiment remaining a little more sustainably intact in the coming year is that the reservoir levels are actually quite good in most regions. And this is something that takes away a lot of the uncertainty related to particularly things like the onset of the monsoon rainfall and how that pans out in the first month or two. So as you know, July is the main month for sowing. And when reservoir levels are quite healthy, then at least we are less concerned about how exactly when the monsoon onset is and how the first 5 to 6 weeks look. So that's one positive. Second is a kind of odd thing that I'm going to say. We are now becoming more apprehensive of a larger shortfall in capital spending this year from the government of India as compared to that 11 trillion budget that Dr. Pant just mentioned. And that would probably give us higher headroom to show a slightly, kind of mid or double digit growth in FY26 while remaining within the likely fiscal contours. We do think that the government will try and target a 4.5% fiscal deficit to GDP ratio. And with smaller capex becoming more and more likely with every month of data that we're getting from the government of India, there would actually be higher headroom to grow next year. So that's a positive. But global risks abound. I mean, this is certainly 1 year where we're very clear that we're looking at a lot of global uncertainty and global risks. And that is something that is going to add a very wide range around baselines for all economists. Now, coming to the RBI, my sense is that it's really going to be the December CPI data point, which is going to be very, very important, which is going to dictate whether the MPC can move ahead, a kind of new look MPC in a sense, can move ahead with a Feb rate cut. Other than that, in terms of the cycle itself, we still think it's going to be a very shallow cycle, 50 basis points spread over two policies.
Okay. All right. Let me just correct what I said about Dr. Pant. The government final consumption expenditure is expected to be only 4.3, but they are expecting personal consumption to improve to 6.9% in FY26. Where will this improvement come from? Will it be urban, Dr. Pant?
Well, if it is, if the inflation pans out the way we are looking at, and our estimate is for this year 4.9, and next year it is likely to be 4.3%, then we will see that likely to see across the board. It can come both from the rural as well as urban. But for rural to happen or to consumption to grow, the 2025 monsoon is very critical. Not only overall, it's spread over space and over time. That will become very critical. If that happens, then I think both rural and urban will contribute compared to the 2024 or FY25.
Yeah. No, I take your point that, as economists and, of course, data journalists, we should start factoring in the climate impact. After all, what took away from the second quarter growth was this extra rains in August and the terrible summer that we had. So climate impinging and taking away growth is going to be an important, probably vertical in economics, which is as yet underdeveloped across the world. But Aditi, should we expect something from the budget? Reform orientation? After all, one meeting with economists is over, both with the Prime Minister himself and the Finance Minister. What would your best guesses be?
Latha, my best sense for this budget is that, what I'm really looking forward to is the unveiling of the new medium-term fiscal consolidation plan. We all know, for this year, the government is targeting a fiscal deficit of 4.9% of GDP, and we expect it to be mildly undershot because of a shortfall in capital expenditure. For next year, the medium-term target was to get to 4.5% of GDP or below, and we expect it to be right around that level in terms of the budget estimate itself that the government puts out. But then we need to look at the fresh medium term, the next 5 years. What exactly is the government targeting? They've indicated that they want to move away from a fiscal deficit target to a debt to GDP target. So what are the contours of that going to look like? And again, coming back to what you were just saying, how are we going to build in, the new set of challenges that the government needs to address over the medium term? Climate risk is certainly one, transition risk, and the new finance commission. We will get the recommendations later on in the year after the budget. That again, how will that get factored into the medium-term fiscal consolidation plan? So some, narrative around these items, I would really be looking forward to in the budget. In addition to, looking at the overall fiscal math for this year itself.
Okay. Dr. Pant, how would you draw the external, situation? It's a lot of guesses now, but we are getting hand over fist orders in terms of EMS. We are becoming beneficiaries of supply chain to some extent. Will that be a positive in terms of driving both private investment as well as consumption?
Look, Latha, looking at the size of trade in Indian economy or overall size in the global trade, India is still a small country. And it's a price taker, it's not
that's what I meant.
price setter. Yes, there will be some improvement. There will be some, we may get some benefit, depends upon how we are able to take advantage of what is happening in our neighborhood, Bangladesh, something on the textiles. We were not able to take full advantage of China plus one. So PLI has been successful in certain sectors. Now, global supply chain, are we part of it? Unfortunately, I will say we are not to the extent we should have been.
Yeah.
So these are these challenges. External, as of now, if I look, we are on a stronger position, but how it is going to evolve post Trump in the Trump era, whether the tariff war or tariff increase, will it be just across the board? If it is across the board, we will be insulated. But if it is Indian exports or Indian commodities which are coming from India, they are targeted. Yes, we will be hit.
Thanks a lot for giving us your idea, Aditi and Dr. Devendra Pant, in terms of Outlook 2025. That's it on this year-ender special. Thanks much for joining us.